Okay, hi everybody. I am doing this recorded lecture for chapter 19 of our intermediate accounting textbook. We got a little practice with chapter 19 and some of these calculations already, but we'll go through the PowerPoints and see some more examples, and then of course get more practice with it in class together. So I'm going to share my screen with you and get the PowerPoint pulled up, and we will go over this. And so, chapter 19, again, we're looking at accounting for income taxes. And as we have already gotten some practice with, there is usually a difference. Most of the time, there's a difference between what we've calculated as net income under financial reporting purposes or for financial reporting purposes, and what we've calculated as and what we calculate as net income for tax reporting purposes. And so we'll look at some of those differences again, and look at some examples and again get some more practice with it in class together. So Chapter 19, some of the major learning objectives: understand the fundamentals of accounting for income taxes, identify additional issues in accounting for income taxes, explain the accounting for loss carrybacks and loss carry forwards, and then describe the presentation of deferred income taxes in financial statements. Okay, so as we discussed already, companies, when they file their income tax returns, they have to follow the Internal Revenue Code set forth by the Internal Revenue Service. However, when we're preparing our books, we follow GAAP, right? And so because GAAP and tax regulations differ in several ways, and we're going to look at some examples of those. We essentially have to calculate income tax expense according to GAAP, and then what our actual income tax payable is according to the IRS, following that Internal Revenue Code. And remember the difference between these two, right? So the difference between these two is either going to be a deferred tax liability or a deferred tax asset, right? And so we're going to look at examples of both of those. We've already gotten some practice with them, but we'll get some more practice with them in class together. All right, so again, thinking about financial statements, which, when we're preparing our financial statements, we're using the financial reporting standards, the generally accepted accounting principles set forth by FASB, Financial Accounting Standards Board, and other agencies that contributed to the creation of the generally accepted accounting principles. But when we're preparing our tax return, we have to follow that Internal Revenue Code. And so just like we see here, pre-tax financial income usually does not equal taxable income for several reasons. Again, we'll get some practice. We'll look at examples of those. And income tax expense, again, usually does not equal income tax payable, because in some cases we've got, a deferred tax liability that we don't have to pay now, but we'll have to pay in the future type deal, or a deferred tax asset that we pay now and then we'll owe less in the future type deal. So, all right, so here's our example that they give us in the book. So Chelsea Inc. reported revenues of 130,000 and expenses of 60,000 in each of its first 3 years of operations. For tax purposes, Chelsea reported the same expenses to the IRS in each of the years. Chelsea reported taxable revenues of 100,000 in 2017, 150,000 in 2018, and 140,000 in 2019. What is the effect on the accounts of reporting different amounts of revenue for GAAP versus tax? So, again, according to our financial statements, financial reporting, we had revenue of 130,000 every year, right? But now we look at Chelsea reported taxable revenues of 100,000, 150,000, and 140,000. So in this example, the difference is going to be based on accounts receivable. But anyway, we'll go through it and look at it. So here's the GAAP reporting or financial reporting versus the tax reporting. And so again, we had revenues 130, 130, 130, expenses 60, 60, 60. And so it shows, across the board what our pre-tax financial income would be, what our income tax expense would be, right? But then when we get down to tax reporting for those same years, what happens is 30,000 of this is accounts receivables, right? And remember, like we talked about in class, for GAAP and financial reporting standards, we would include those accounts receivables in our revenues. But for tax reporting purposes, we do not include those in our revenues, right? So that represents that $30,000 in accounts receivables that hasn't been collected yet, basically. So there's where our difference starts, right? And then what basically is happening here is, so this 30,000 in accounts receivables, we're collecting 20,000 of it in 2018, and we're collecting 10,000 of it in 2019. And so that's why we've got here 130,000, but according to tax reporting, it's 150 because we're collecting that extra 20,000 in from our accounts receivables, right? Same thing here. For GAAP, we're reporting revenues of 130, but because we collected 10,000 in accounts receivable, for tax purposes, we're reporting 140. Because remember, the accounts receipt, we do not have to pay taxes on it, basically, or we are not obligated to pay taxes on it until we've actually collected the cash, right? And so that's why we've included the accounts receivable for GAAP reporting purposes or financial reporting purposes, but it's not included in our tax reporting until the money is actually collected, right? And so we see here, for example, instead of taxable income of 70,000, we only had taxable income of 40, right? Since we collected the extra 20,000 here, instead of taxable income of 70,000, we've got taxable income of 90, right? Because we collected the extra 10 here, instead of taxable income of 70, we've got taxable income of 80. So it's just a little bit different. In this case, we would consider this a deferred tax liability, right? Because we're going to owe taxes on that as the money, as we collect on the accounts receivables. All right, so book versus tax differences. We've just looked at an example of that. I know we've talked about it a little bit in class already, but this is just showing us, again, according to GAAP, we had a $28,000 income tax expense. But according to the Internal Revenue Code, the IRS, we only had tax payable of 16,000. So that difference, that $12,000 difference, is that deferred tax liability. Deferred tax liability. And again, it's a deferred tax liability because we're going to have to pay that in the upcoming years, basically. And so that's what it's showing us here. So 2018, we only had, according to GAAP, according to our financial reporting, we only had income tax expense of 28. But again, we collected that extra money from accounts receivables. So we actually had to pay the IRS 36,000. Same thing in 2018, we only had taxable, according to financial reporting, we only had taxable income tax expense of 28,000, but because we collected 10,000 of accounts receivables, we have to pay the IRS 32,000, right? So that's that 12,000 being allocated as those accounts receivables are collected, basically. And so what it's showing here is that that deferred tax liability when we, oh, I meant to underline it, not do that. But that deferred tax liability in 2017 increased 12,000. But then in 2018, we collected 20,000 of the accounts receivables, and that equaled an $8,000 extra tax liability in 2018. So then this deferred tax liability account was reduced by 8,000. 2019, we collected the remaining 10,000 accounts receivables. So then that deferred tax liability account would have been reduced by 4,000 once we paid taxes on that. All right, future taxable and deductible amounts. So we talked about temporary differences versus permanent differences, and we're going to look at examples of both of those. But the temporary difference is the difference between the tax basis of an asset or liability and its reported carrying or book amount in the financial statements. That will result in either taxable amounts. If it's a liability, it'll result in taxable amounts, or deductible amounts if it's a deferred tax asset, right, in future years. So future taxable amounts or deferred tax liability represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the year, end of the current year. So again, in that Chelsea example that we looked at, we had 30,000 of accounts receivables in 2017. And then, and so in 2017, we created the deferred tax liability, right? But then in 2018, we collected 20,000. So we paid a portion in 20,000 or in 2018 rather. And then in 2019, we collected 10,000. So again, we had to pay 40% tax on that in 2019, right? Future deductible amounts. So deferred tax asset represents the increase in taxes refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. So again, we're going to look at examples of both of these, but the couple examples that your book gives us, like when we have a warranty liability that hasn't occurred yet, that's a good example of it. And then also like a lawsuit liability that hasn't occurred yet. So, remember that like with a lawsuit, for example, if it's probable and reasonably estimatable that we will have to pay out, we have to record it in our books according to financial reporting standards. But according to the IRS, we don't have to report that, or we cannot report that as an expense until we actually pay it, right? So it results in deferred tax assets. So anyway, we'll look at some examples of those. All right, so it says in Chelsea's situation, the only difference between the book basis and the tax basis of the assets and liabilities relates to accounts receivables that arose from revenue recognized for book purposes. Chelsea reports accounts receivables at 30,000 in December 31, 2017 GAAP basis balance sheet. However, the receivables have a zero tax basis. So again, this is where we would have the deferred tax liability because, basically we're calculating income tax expense with this 30,000 included, right? But we don't actually have to pay that amount until the accounts receivables are collected. All right, reversal of the temporary difference. And we saw this a few slides ago. In 2017 is when we had the 30,000 in accounts receivable. We collect 20,000 in 2018. We collect 10,000 in 2019. And that's when we have to pay income taxes on it, right? So these are future taxable amounts or a deferred tax liability, right? Deferred tax liability. All right, so with the example of Chelsea, and I know we saw this a few slides ago already, but A deferred tax liability represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. So, again, our actual income tax expense, according to financial reporting purposes, was 28,000, but we only had to pay 16 to the IRS because we hadn't collected on those accounts receivables yet. We hadn't collected that cash yet. But now in 2018, we collect 20,000 times 40%. That's our 8,000 that we're paying in 2018. And then in 2019, we collect 10,000 times 40%. And then that's our 4,000 that we're going to pay in 2019, right? All right, it says because it is the first year of operations for Chelsea, there is no deferred tax liability at the beginning of the year. Chelsea computes the income tax expense for 2017 as follows. So we already calculated at the end of 2017, it's 12,000. There was a zero beginning balance. So in fact, we have deferred tax expense for 2017 of 12,000. Current tax expense for 2017, 16,000. So total income tax expense 28. But again, that income tax expense, that's based on our financial reporting numbers, our income statement, our financial reporting under GAAP. But we actually only have to pay the 16,000 to the IRS. So the other 12,000 is the deferred tax expense. And so that journal entry, I know we saw this a few times in class already, but that journal entry to record this, we would debit income tax expense for the whole amount. We would credit income tax payable. So we debit income tax expense for the entire amount based on our pre-tax financial income, right? We credit income tax payable for what we actually owe the IRS. And then that difference, that $12,000 difference, is that deferred tax liability. All right. The end of 2018, again, now we've still got that 28,000 income tax expense. But now we've collected on 20,000 of those accounts receivable. So this deferred tax liability, we take 20,000 times 40%, right? We got to pay 40% taxes on that 20,000 we collected. So that deferred tax liability is getting reduced here by 8,000. And we actually have to pay both of these two added together now. Income taxes payable, 36,000, right? And then we see the same thing for 2019. Again, 2019, we calculate the expense the same way we did in the previous 2 years, but now we've collected on the remaining 10,000 accounts receivable. So 10,000 times the 40% tax rate. Now we're reducing that deferred tax liability by 4,000. And now we've got to pay both of these amounts together, income tax payable to the IRS. Okay, future deductible amounts. So now this is where we're talking about deferred tax asset, right? Deferred tax asset, future deductible amount. So during 2017, Cunningham Inc. estimates its warranty costs related to the sale of microwave ovens to be $500,000, paid evenly over the next 2 years. For book purposes in 2017, Cunningham reported warranty expense and a related estimated liability for warranties of $500,000 in its financial statements. For tax purposes, however, the warranty tax deduction is not allowed until it's paid. So again, per our financial reporting standards, we would record that liability, right? But for tax purposes, it's not, we can't record it until it's paid, basically, right? We can't record the expense until we actually pay it. So we see that example here. So it would create that difference, temporary difference of 500,000. And then we would end up actually being able to claim half of the expense in 2018, half of the expense in 2019. So it says when Cunningham pays the warranty liability, it reports an expense or a deductible amount for tax purposes. Cunningham reports this future tax benefit in the December 31, 2017 balance sheet as a deferred tax asset. So again, for financial reporting purposes, we were able to claim the 500,000 in expenses. That reduced our pre-tax financial income. However, for taxable purposes, we can't claim that expense until we actually pay it. We can't claim the warranty expense until we actually pay the warranty liability, right? And so even though we were able to claim the expense back here in 2017, we're not actually paying it and getting the deduction for tax purposes until 2018, 2019. So this is a deferred tax asset is what we're looking at. So a deferred tax asset represents the increase in taxes refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. So here's another example of a deferred tax asset entry. It says Hunt Company has revenues of 900,000 for both 2017, 2018. It also has operating expenses of 400,000 for each of these years. In addition, Hunt accrues a loss and related liability of 50,000 for financial reporting purposes because of pending litigation. So this is, pending litigation like a lawsuit, right? And so remember with our lawsuit, if it's reasonable and it's easily estimatable, and we have our 50,000 here that we're estimating that we're going to owe rather on this pending litigation. Hunt cannot deduct this amount for tax purposes until it pays the liability expected in 2018. As a result, a deductible amount will occur in 2018 when Hunt settles the liability, causing taxable income to be lower than pre-tax financial information. All right. So here's an example of what that looks like. So in 2017, we reported the litigation loss, which brought our pre-tax financial income down to 450,000 times 40%. Income tax expense would be 180,000, right? However, for tax reporting purposes, we can't claim that 50,000 yet. So our taxable income's actually 500,000. So income tax payable are 200,000, right? And so this would be one of those where we'd end up like, and it might show this to us on the next slide, but we'd end up reporting income tax expense for 180. We would debit deferred tax asset for 20,000. And again, that 20,000 is this 50,000 times 40%. We're going to owe 20,000 basically on that. Or we will have prepaid 20,000 on that. And then we credit income tax payable for the entire 200,000. Okay. All right, so it says Hunt can compute the deferred tax asset by preparing a schedule that indicates the future deductible amounts to deductible temporary differences. Again, that's what creates that deferred tax asset. We're going to pay it in 2017, but for tax purposes, we actually can't claim the expense until 2018. It says, assume that in 2017 is Hunt's first year of operations and income tax payable is 200,000. Compute income tax expense. Again, we've got that deferred tax asset of 20,000. So the expense that we would claim would be 180,000. So we debit this, we credit this, right? And so here's that entry: debit income tax expense, debit deferred tax asset, credit income taxes payable. All right, so computation of income tax expense for 2018. So 2018 now, we pay the lawsuit, 50,000. And so that increases our expenses for tax purposes, right? We already claimed the expense back in 2017 for book purposes or for financial reporting purposes. But now we get to claim this 50,000 in expenses for tax purposes. So that reduces our income taxes payable. Reduces that income taxes payable to 180,000. Because we already prepaid, basically. We had that deferred tax benefit of 20,000. And so we'll see when we get to claim that. We get to claim that expense in 2018. So we're paying, we already paid in the 20,000 in 2017. That's our deferred tax asset, right? And so now, even though our income tax expense is 200,000, because we already paid in the 20, we only have income taxes payable of 180,000. All right, the deferred tax asset. So just like we do with like the allowance for doubtful accounts, for example, we also have a valuation allowance for deferred tax asset. And so this says a company should reduce a deferred tax asset by a valuation allowance if it is more likely than not that it will not realize some portion or all of the deferred tax asset. So more likely than not means a level of likelihood of at least slightly more than 50%. And so when we do this, and I was just trying to point to the page that it talks about this real quick. It looks like it talks about this page 1063, and it's allowance to reduce deferred tax asset to expected realizable value, right? So that's what we're calling that, allowance to reduce deferred tax asset to expected realizable value. And that, you know, again, just like it shows us on page 1063, that reduces, it's a contra account. It reduces that deferred tax asset. All right, so here's our example of that. It says Callaway Corporation has a deferred tax asset balance of 150,000 at the end of 2017 due to a single cumulative temporary difference of 375,000. At the end of at the end of 2018, this same temporary difference has increased to a cumulative amount of 500,000. Taxable income for 2018 is 850,000. The tax rate is 40% for all years. No valuation account is in existence at the end of 2017. Assuming that it is more likely than not that 30,000 of the deferred tax asset will not be realized, prepare the journal entries required for 2018. And so, ooh, hot dog, hold on. I'm going the wrong way. Hot dog. Okay, and so we see the information here for the entries. And so we've got when initially creating the deferred tax asset, right? We have the debit to income tax expense, debit to deferred tax asset, credit to income taxes payable, right? But if for whatever reason we think that we're not going to be able to take advantage or use this deferred tax asset, then we would have the debit to income tax expense credit to the allowance for the deferred tax asset. So essentially what this is doing is it's reducing this deferred tax asset from 50,000 down to, we subtract the 30. So it's reducing it down to 20,000 then. All right. All right, and then and we looked at this a little bit in class together, but on our balance sheet, we would just show that deferred tax asset less that allowance, which I guess I was going by the numbers that they had right here, not considering beginning balances, but either way, that allowance for the deferred tax reduces that deferred tax asset. All right, so some additional considerations, what we need to be looking at when we're thinking about income statement presentation is the income taxes payable or refundable, plus or minus the change in deferred income taxes. And this is, either a change in deferred tax liabilities or a change in deferred tax assets, whichever the case may be, or both maybe, right? And we actually show the net amount when there's both. So when there's both a deferred tax liability and a deferred tax asset, we show the net amount of the two. And that equals the income tax expense or benefit. So it says here in the income statement or in the notes to the financial statements, a company should disclose the significant components of income tax expense, both current and deferred. Again, we got some practice with that in class a little bit already, and we'll get some more practice with it together. All right, so some temporary differences versus permanent differences. We're going to look at examples of both of them, but taxable temporary differences are the deferred tax liabilities that we have been talking about. Deductible temporary differences lead to the deferred tax assets like we've looked at. So here's some examples, and I'm not going to read through all of these, but if revenues or gains are taxable after they are recognized in financial income. So number one, sales accounted for on the accrual basis for financial reporting purposes, but on the cash basis for tax purposes, right? Contracts accounted for under the percentage of completion method for financial reporting purposes, but under the portion of related gross profit deferred for tax purposes. Investments accounted for under the equity method for financial reporting purposes and under the cost method for tax purposes. So just giving us a few examples of these temporary differences, right? Expenses or losses are deductible after they are recognized in financial income. So product warranty liabilities, estimated liabilities related to discontinued operations or restructuring, lawsuit or litigation accruals, bad debt expense recognized using the allowance method for financial reporting purposes, but the direct write-off method for tax purposes, stock-based compensation expense, unrealized holding losses for financial reporting purposes. Another type of temporary difference, revenues or gains are taxable before they are recognized in financial income. So this happens when we get like unearned revenue, subscription revenue received in advance, advance rental receipts, sales and leasebacks for financial reporting purposes, income deferral, but would have to be, because we've collected the cash already, would have to be reported as sales for tax purposes. Expenses or losses are deductible before they are recognized in financial income. So they're deductible for tax purposes, but not for financial income purposes. And so depreciable property, depletable resources, intangible, deductible pension funding exceeding the expense, prepaid expenses that are deducted on the tax return in the period paid. Some of the permanent differences, however, right? Because there can be permanent differences. Items are recognized for financial reporting purposes, but not for tax purposes. And so some examples of these: interest received on state and municipal bonds, for example, like state and municipal bonds, you do not have to pay federal income tax on. So, that's something that would be a permanent difference between our financial reporting and tax reporting. Expenses incurred in obtaining tax exempt income, proceeds from life insurance carried by the company on key officers or employees, premiums paid for life insurance carried by the company on key officers or employees, fines and expenses resulting from a violation of the law. It says items are recognized for tax purposes, but not for financial reporting purposes, like percentage depletion of natural resources in excess of their cost, or the deduction of dividends received from United States corporations. So again, some of the differences can be permanent. Okay, tax rate considerations, future tax rates. So if we know that the tax rates are going to change, then we can make an adjusting entry for what we anticipate our income tax liability to be. And so that's what it's telling us here. A company must consider presently enacted changes in the tax rate that become effective for a particular future year when determining the tax rate to apply to existing temporary differences. In determining the appropriate enacted tax rate for a given year, companies must use the average tax rate. Net operating losses. We also talk about in this chapter net operating losses when our expenses exceed our revenue, right? So tax deductible expenses exceed taxable revenues, then we have an operating loss or a net operating loss. The federal tax law permits taxpayers to use the losses of one year to offset the profits of others' years. So basically, we can carry back 2 years, we can carry forward 20 years. And so I think the next slide shows us an example of that. And so back 2 years, forward 20 years, losses must be applied to the earliest years first. So for example, let's just say in 2017, here's our loss. Let's just say we've got $100,000 loss, just to make the math easy on me. We can carry back 50,000 of that loss to here. We can carry back 50,000 of the loss here. And we do that through an amended, oh Lord have mercy, amended tax return, right? So if we had profits in 2015, 2016, we would go back and we'd file an amended tax return and we'd split up those losses, right? We could do it that way. We could also carry forward 20 years. So we could also carry them forward. So we have that option where, again, these are for tax purposes, right? Loss carry back, loss carry forward. These are for tax purposes or tax reporting purposes. Loss carry forward may elect to forego loss carry back and carry forward losses 20 years. If we had that, again, just to make the math easy on me, if we had 100,000 loss, maybe we want to carry it forward 20 years. Maybe we want to, claim 5,000 loss each year type thing for 20 years, right? Carry it forward. Okay. All right, the valuation allowance. So whether a company will realize a deferred tax asset depends on whether sufficient taxable income exists or will exist in the carry forward period. So again, that's why we have that allowance, because, if we got that deferred tax asset, but we don't have sufficient taxable income, we might not be able to use that deferred tax asset, right? So some of these taxable income sources: future reversals of existing taxable temporary differences, future taxable income exclusive of reversing temporary differences and carry forwards, taxable income in prior carryback years if carryback is permitted under the tax law, and then tax planning strategies that would, if necessary, be implemented to: one, accelerate taxable amounts to utilize expiring carry forwards, change the character of taxable or deductible amounts from ordinary income or loss to capital gain or loss, or switch from tax exempt to taxable investments. Balance sheet. So income taxes payable and income tax refund receivable should both be reported on the balance sheet as a current liability or current asset. Obviously, income taxes payable is the current liability. Income tax refund receivable would be the current assets, right? It says companies should classify deferred tax account as net non-current amount on the balance sheet. So here it's showing us an example of that net amount. And I mentioned this earlier: when we have both a deferred tax asset and a deferred tax liability, we have to report the net amount. So here's an example of the deferred tax asset, right? So rent collected in advance, recognized when a performance obligation is satisfied for accounting purposes and when received for tax purposes. So that's an example of a deferred tax asset, right? Number two, use of straight line depreciation for accounting purposes and accelerated depreciation for tax purposes. That's a deferred tax liability. Recognition of income on installment sales at the time of the sale for accounting purposes and during the period of collection for tax purposes. And then the last one here: warranty liabilities recognized at the time of sale for accounting purposes and at time paid for tax purposes. So if we've got deferred tax assets of 54,000, deferred tax liabilities of 259, the net amount of those is 205. So we've got a net deferred tax liability. All right, income statement. It says companies are required to report income before income taxes and income tax expense on the income statement. This is just showing us example of PepsiCo reported the following amounts related to tax expense. And I didn't even do the calculation on it, but our book's been using 40%, so I'm assuming they're probably using 40% on this. All right, the asset liability method. So FASB believes that the asset liability method, sometimes referred to as the liability approach, is the most consistent method for accounting for income tax. So the basic principles, the first one here, letter A: a current tax liability or asset is recognized for the estimated taxes payable or refundable on the tax return for the current year. Letter B: a deferred tax liability or asset is recognized for the estimated future tax effects attributable to temporary differences and carry forwards. Letter C: the measurement of current and deferred tax liabilities and assets is based on provisions of the enacted tax law. The effects of future changes in tax laws or rates are not anticipated. And then finally, letter D, the measurement of deferred tax assets is reduced if necessary by the amount of any tax benefits that, based on available evidence, are not expected to be realized. This is when we use that allowance account. All right, and then this illustration from your book, and I don't know, let me try to figure out what page this is on for us. This is just kind of showing us a flow chart of how we would analyze these. This is actually shown on page 1082. So identify types and amounts of existing temporary differences and carry forwards. Measure deferred tax asset for deductible temporary differences and loss carry forwards. Measure deferred tax liability for taxable temporary differences. And then if we have that deferred tax asset, establish a valuation allowance account if more likely than not that some portion or all of the deferred tax asset will not be realized. And remember, they said that this is if it is greater than 50% chance, basically, that we will not be able to realize it. On the balance sheet, we classify deferred taxes as either net non-current deferred tax assets or non-current deferred tax liabilities. On the income statement, we report current tax expense and deferred tax expense and total income tax expense. And we saw that current, deferred, and then total. We've seen that together already. So, okay, hopefully that was helpful going over chapter 19 like that. Again, when we're back in class, we'll get some more practice with it. And as always, once you guys have a chance to read the chapter or view this recorded lecture, please let me know if you have any questions. Bye-bye, guys. I'll see you later. Bye-bye.